folks. In today's video, we're going to break down the top 4 stocks to buy heavy in April 2026. Each of these stocks is down very far from its all-time highs, has huge long-term potential, has a huge competitive moat, and most importantly, is currently a great buy. I'm going to make the case for each of these, and I'll let you be the judge. And then it's going to be time for our sponsored segment on NVNI Group Limited, also known as Nuvini, ticker symbol NVNI on the NASDAQ. They're building what they describe as the premier B2B software serial acquirer in Latin America, buying and operating profitable SaaS companies across the region's fastest growing economies. I'll present the company and why you may want to take a look. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, let's start with the market. So today's market is very much dominated by the Iran conflict, and it's very much a push and pull market. There are 2 scenarios that markets have been fighting to price in. Scenario 1, the taco, Trump backs off, and scenario 2, the endemic conflict. Every time you get evidence that we get closer to scenario 1, markets pump massively. Every time it's looking like scenario 2, markets sell off. Now, of course, you need a crystal ball to know exactly how this conflict is going to end. And the latest iteration of this, the recently declared ceasefire, is, well, anyone's best guess as to whether it's going to hold or not. Now, for anybody investing in 2026, it can very much feel like your entire portfolio is based on whether or not Trump does XYZ. And if he flips on XYZ, your portfolio can flip 10, 20, 30, even 40%. And so certainly a lot of folks are very frustrated about this. And this is a theme that we've seen time and time again, whether it was with Greenland, tariffs, various Supreme Court rulings. The Fed portfolio valuations over the short term tend to be very, very correlated with a lot of short-term variables that are very much out of all of our control. So how does one navigate this? Well, please open up the damn chart. If you are buying an actual quality asset and holding for the long term, your long-term chart looks like this. And most people are extremely scared of this area here, this small section of downturns and fakeouts, because they feel like fools when they buy the dip, and the dip continues to dip. It's like a triple layer dip. People don't like that, right? Even the biggest so-called fool that bought before the entire downtrend here still got a better entry price than much of the last half of the chart. And if they were buying slowly over time all the way back here, well, their average is probably way lower than that temporary peak was anyways. If you're somebody that's actually buying good assets over time, you don't have to have a crystal ball. You just have to open up the chart and understand the broader long-term context, and that the short term does not equal the long term. And because something is down right now and because it's been going down doesn't mean it's going to continue to go down, or that that asset isn't actually a great buy long term. It just means that right now the macro conditions are such that that stock is down. If you go and you zoom back into this little area here alone, we see a shit failing stock, right? And a lot of people would say, yeah, this stock is terrible. It's absolutely terrible. But then if you zoom out again, you see the long-term value creation for folks that actually saw that value and wanted a piece of it instead of just headline jockeying around. And my goal of these videos is to continue to bring you stocks that fit that bill, that are actually good buys and are actually an opportunity in today's market condition. So with that in mind, let's start with stock number 4. Okay, let's start with the 4th, Robinhood, ticker symbol HOOD. Now, Hood has been cut in half since October highs. If you look at the price to sales ratio, you're now paying 14 times sales instead of the 31 you were paying in October. The stock got cut in half, but the business didn't. Hood has aggressively built out a very impressive brokerage, options, crypto, futures, margin lending, credit card, retirement account, prediction market, and venture fund apparatus. They have over a dozen different business lines, each generating meaningful revenue on their own. Stickiest part of their business, their gold subscriber tier, keeps growing fast and generating reliable recurring revenue. Average revenue per user keeps climbing, and they're not just adding new accounts, they're deepening the relationship with the accounts they already have. That's a sign the business is creating and building very nice, beautiful, long-term value. Now, on top of this, Robinhood was just named alongside BNY Mellon as one of the platforms to run the new federal Trump accounts program. If you haven't heard about this, the government is creating saving accounts for American children with a federal contribution at birth, and the platform that will be chosen to handle these accounts for millions of American kids is Robinhood. This is basically a government-backed mandate that puts Robinhood in front of an entire generation of American investors before they even make their first trade. Kids are going to be growing up using the Robinhood platform. They're going to learn about investing for the first time through Robinhood. That's going to have very long-term implications for them. It's going to plant that brand seed for them. So the bottom line here is the stock got cut in half on sentiment and environment, not because anything broke inside the business. And underneath the sell-off, you have a very beautiful maturing fintech platform with a growing subscriber base, a government-mandated pipeline to the next generation of investors, and management actively buying back stock. Wall Street's median price target implies north of 70% of upside from here. And so very beautiful stock, very beautiful setup right now. And on top of that, management just authorized a massive share buyback. They're not panicking about the stock price. They're buying it. That's confidence from the inside, and that's definitely worth paying attention to. Okay, third stock, Nike, NKE. So Nike hit its all-time high back in November of 2021. Today it's sitting near prices last seen in 2014. 12 years of stock market gains completely erased the most recognized athletic brand on earth, taken back to the Stone Ages in terms of price. Now, there are real reasons why the stock is down so much. It's not just conditions. The prior CEO was a complete mess, and he made 3 decisions that were a complete disaster for this company. First, he pulled Nike away from its wholesale partners, the Dicks, the Foot Lockers, the retailers where regular people actually buy sneakers, and tried to force everything through Nike's own digital channels. That was a mess. That strategy made sense on paper, but destroyed the brand's physical presence in the market. Second, he stopped innovating on performance products and instead leaned into the classic franchise lines, the Dunks, the Air Force Ones, the Jordans. He pumped those lines so hard and so frequently that the market got completely saturated with them and they lost their appeal. The shoes that were once rare and coveted became things you could find anywhere. And third, while Nike was busy flooding the market with its own classic silhouettes, competitors like On Running, Hoka, and New Balance stepped into the performance gap Nike left open and built loyal, younger audience that Nike still hasn't fully won back. That CEO was a complete disaster, did a terrible job. Now we have a new CEO. And that new CEO is Elliott Hill, a 32-year Nike veteran who came out of retirement specifically for this job. He walked into this mess and has started working to unwind all 3 mistakes at once. Now, I actually think that this turnaround is going to take time. And markets do too. That's why the stock has been discounted so much. However, I believe at current prices, it's just looking like an obvious buy. The discount is just too severe. The brand alone should be worth well over what the stock is trading at. Second stock, CRM, Salesforce. Salesforce peaked at an all-time high just above $365 in December of 2024. Today it's sitting at around $185. That's a roughly 50% decline from the top on one of the most deeply embedded enterprise software companies in existence. If you look at the PE ratio, you're now paying around 22.58 times earnings, which is about half of what you were paying a year ago and a fraction of what you would have paid at many points historically. And right now, software is in a massive bear market as everybody's panicking and trying to guess which companies are going to be destroyed by AI. However, this is not a company that's going to be destroyed by it. It's one that's going to be massively helped by it and is going to help do the destroying that destroys other areas of the market. Once a company builds its entire sales operation, customer support workflow, and marketing automation on Salesforce, well, pulling it out is a multi-year, multi-million-dollar nightmare. The switching cost is so high that most large companies would rather pay any price increase than go through the disruption of moving off the platform. That kind of lock-in is one of the most valuable things a software company can have, and markets are completely dismissing this right now. So I think there's a huge rebound story to be had on that alone. However, when it comes down to its future and its most exciting areas, well, Agentforce is number one. Agentforce is Salesforce's AI agent platform, and it's one of the most important product launches the company has had in more than a decade, perhaps ever. The idea is simple. Instead of a human going into Salesforce and manually updating records, writing follow-up emails, routing support tickets, or generating sales reports, well, an AI agent does all of it automatically. The agent works inside your Salesforce data, knows your customers, knows your workflows, and executes tasks without being asked every time. This is what the move from software to AI actually looks like in the enterprise world, and the adoption data is not theoretical. In fact, here are the real numbers. Salesforce closed roughly 29,000 Agentforce deals in fiscal 2026. Quarter over quarter, paid Agentforce transactions grew roughly 50%. The U.S. Department of Labor deployed Agentforce to enhance citizen support. The Veterans Health Administration deployed it to save thousands of staff hours for frontline veteran care, and AstraZeneca is using it to transform customer engagement globally. So these aren't pilot programs anymore. These aren't like theoretical numbers that could happen one day. No. You're seeing real deployment in the real world. The company right now is investing a lot in client acquisition, and software is something that people are scared of right now. However, long term, it has its teeth in a lot of different areas of the economy. And so I have a hard time believing that CRM Salesforce is not a buy at current prices. Okay, next, number one, Applied Digital, APLD. So this one's a little bit different from the others. And for context, we've been fans of this one since a mere fraction of current trading prices, as you can see here. But let's be real, APLD peaked around $42 in late 2025, around October, just like all the other ones did. And that's about a 40% discount. Now, that's not the most extreme drawdown on this list today. However, it is quite extreme considering how aggressively successful the recent earnings report was. And that earnings report just came out actually a couple hours ago. The street was looking for around $76 million in revenue. Applied Digital just printed $126.6 million, a beat of nearly 66% over estimate, and overall revenue that was up 139% year over year. They also delivered positive adjusted EBITDA and adjusted net income for a company that Wall Street was trying to treat like a speculative crap infrastructure AI bet. Well, those are not speculative numbers. That's real revenue coming in at a massive pace. And we love that. Now, APLD designs, builds, and operates massive data centers, not the kind that run general cloud computing, but the kind specifically engineered for the extreme power density and cooling requirements of AI and high-performance computing. We're talking about the facilities that handle GPU clusters running AI model training and inference around the clock. That's a fundamentally different technical challenge from a standard data center, and it's a very, very important part in the overall AI infrastructure build-out right now. Now, the anchor of this company is really the CoreWeave relationship. CoreWeave is one of the most important AI cloud companies in the world. NVIDIA backed one of the fastest growing companies in the entire tech sector, and CoreWeave chose Applied Digital to build and operate their AI compute infrastructure. The contract value tied to APLD's North Dakota campus runs into the billions over a multi-year time frame. On top of that, the company just broke ground on Delta Forge 1, a new 430 megawatt campus in Louisiana, meaning the pipeline is actively expanding, not standing still. The company has also very intelligently structured their financing. Rather than constantly issuing shares to fund construction, they've raised capital against the data centers themselves as physical assets, similar to how airports or toll roads are financed, borrowing against the contracted future rent payments from tenants. That's a more sustainable model for a company building at this kind of scale. So anyways, the world needs a lot more compute. This is a company right in the middle of it, and the company also happens to be down 40% or so from its recent highs at the same time where it's absolutely blowing out in terms of earnings. Anyways, let us know your favorite ideas down below, and now it's time for our sponsored segment. And now it's time for our sponsored segment on Nuvini, NVNI Group Limited, ticker symbol NVNI on the NASDAQ. So at a high level, Nuvini's model is relatively straightforward. The company acquires profitable niche B2B software businesses primarily in Brazil and across Latin America, and then operates them through a shared platform. In its investor materials, Nuvini describes this as a repeatable strategy built around acquiring, growing, and reinvesting into software businesses that already have established products, customers, and cash flow. To understand the opportunity they're targeting, you have to look at the broader market. According to the company's investor presentation, the Brazilian SaaS market was approximately $9.2 billion in 2024 and is expected to grow to around $19 billion by 2030, representing a potential 12% compounding annual growth rate. The company characterizes this market as large, growing, and fragmented, which it believes may create opportunities for consolidation through acquisition strategies like the one it is pursuing. Now let's take a look at what they built so far. This is not just a concept. So based on the company's presentation, Nuvini's platform includes more than 22,000 customers across its portfolio companies, with projected 2025 revenue of approximately $35.8 million. The company also reports gross margins of around 69.6% and adjusted EBITDA of about $9.6 million, or roughly a 26% margin. So what you're looking at here is an existing portfolio of operating software businesses with established revenue and profitability metrics. That portfolio is diversified across multiple verticals. Nuvini has acquired companies operating in areas such as enterprise resource planning, e-commerce infrastructure, marketing, automation, data analytics, and cross-border logistics, according to their presentations. Many of these businesses focus on specific vertical use cases, such as software for government procurement processes, retail management systems, or B2B commerce platforms, which is consistent with the vertical SaaS model. From a strategy standpoint, the company outlines several core pillars behind the model. These include what it describes as a large and fragmented addressable market, a repeatable M&A engine, a scalable multi-vertical platform, experienced leadership, and a visible acquisition pipeline. The overall idea, as presented by the company, is to combine disciplined capital allocation with operational support to scale acquired businesses over time. One area the company is increasingly focused on is artificial intelligence. According to the presentation, Nuvini has built a centralized system called the Nuvini AI Lab, designed to develop AI solutions and deploy them across its portfolio companies. Now, the most significant recent development for the company came on April 6, 2026, when Nuvini announced a definitive agreement to acquire a 51% controlling stake in the American business of BeyondSoft Corporation. If completed, the company has stated that the combined platform would reach approximately $148 million in pro forma revenue for 2025, representing a substantial increase in scale. According to the company, this company could create revenue synergy and cross-selling opportunities across regions, although the transaction, of course, remains subject to closing. Now, it's important to understand that this is a super small cap, very high risk stock. Lots of things could not work out. The company has also disclosed that it received a NASDAQ compliance notice in early 2026 related to minimum market value requirements, with a deadline to regain compliance later in the year. More broadly, continued performance depends on the company's ability to identify, acquire, and integrate businesses effectively over time, which of course is very challenging. Small cap companies also tend to have very high dilution risk, and these are all things to consider when you're reading over their SEC filings and doing your own due diligence. But bigger picture, what Nuvini is attempting to build is a platform that acquires profitable B2B software companies, operates them within a shared infrastructure, and seeks to improve improve performance through scale, operational support, and centralized tools, including AI. The company is focused on a region it believes is growing and underpenetrated and is now beginning to expand beyond Latin America through larger transactions. Anyways, if you'd like to learn more about this company, I'll put the link to their investor relations page down below alongside our disclosures and disclaimers, and make sure to do all your own research and come to your own conclusion and be the ultimate judge. Have a great rest of your day. We'll see you next time.